Shout out to all of you online. It was good. Let's see where we were at right here. How you doing, my people? Brian, Karen, Blessing, Anna. What's good? What's good? What is it? There you go. Facebook. Yeah, Facebook sees it right. All right. Let me come up on to John. Don't worry about it. Today's going to be a good day. Got the cafecito, espresso. Let me tell you something. This coffee, you dip like this. How much is your program? What will not only teach me to fix my own credit, but also show me how to help others? That's the professional do-it-yourself credit repair system. When I answer all your questions in a few. Hey, Lucy. What's up, Cynthia? All right. Michael Johnson. How are you doing, my man? Love you what you do. Thank you, Michael Johnson. Let me get John on the line. All right. Do you guys go and do crazy shopping already? Did you guys go already and went shopping like crazy today? Did you guys stack up for coronavirus? Have any of you stacked up for coronavirus? Over here, John. How you doing? Good. All right, so guys, I need to see if you guys hear us well. John, as you know, the markets today have been going crazy with coronavirus this, coronavirus that. We don't exactly know if it's caused by the coronavirus or something else in the economy that's happening. Of course, this is a hot topic. By now, all of you should know what coronavirus is, COVID-19. We're not experts in any medical field. All right, but we are.
It's more based around just, you know, the effects it's going to have, right? Just as a circulating effect, as, you know, almost a trickle down that it's having on everybody. You know, I mean, anytime you get a stock market that's down 20% in 12 trading days, I mean, you're going to start feeling it everywhere, outside of just the obvious wealth effect, you know, occurrence that goes on when things like that happen, you know. But I don't know if you want me to jump in or if you wanted to prep it even further.
I'm just prepping it, Jay, because, you know, I went to ShopRite last night. Everything was all the Clorox stuff was gone. Everything, people panicking. You know, I don't know how Florida is right now, but with it. But I don't know how many cases you guys have. But you already know, people going crazy.
Yeah. I mean, you're close to New York too, and there's a lot going on with New York. And then I think, you know, they declared an emergency yesterday. So I mean, I think, you know, that's why you're getting all this mayhem. Honestly, I look, I don't want to downplay anything. I don't want to make it. I don't want to trivialize or marginalize it. Obviously, people are losing their lives, but this kind of mayhem, this kind of panic there's a in the stock market, there's a fear index. It's called the VIX, right? It's the relative volatility of stocks, meaning how aggressively they move and how quickly they move. And most of the time, it's indicative of a lot of selling. It's when people buy a lot of puts, but people use it as a way of, measuring how quickly stocks are going to move in a certain direction, most of the time down. And just to give you a point of reference, the VIX is as high right now as it was when we had the crisis in 08. Right, 08, 09, 2010, which obviously this is a totally different type of issue, right? I mean, this is a biochemical scenario outside of the oil stuff that went on overnight. But I mean, it's just the pandemonium that is going on right now, and just I see it down here in Florida when it's comparable to like what happens when hurricanes come, right? When the media starts pumping out hurricane stuff, and there's a hurricane coming down the track, you start seeing people do crazy stuff, right? Like, you know, they're filling their gas tanks up 2 weeks in advance or a week in advance, knowing they're going to have to come back in like 2 days and do it again, but they're there like 5 o'clock in the morning doing it with cans and stuff. They clean out supermarkets, they clean out Home Depots, and then the hurricane doesn't come, right? But sometimes it does, sometimes it doesn't, right?
You guys hear John nicely? Let me know.
I see almost identical. You guys don't see it in other parts of the country. Only down here in Florida do we really see it, and probably parts of the Panhandle about the hurricane stuff. And you see it from a distance, but you don't really feel it. Now you're seeing the same idea happen with this coronavirus, because everybody is just, the media is just getting everybody just next level type like angst. I mean, it's crazy, and it's indicative of the market. I mean, you're seeing the market. The market is basically just a walkthrough of where we're at as a society, right? Generally speaking, and the kind of decision or indecision that exists. And obviously over the last 2 weeks, the market's been crazy. So,
do you have money in stocks, Jay? You could talk about that.
Absolutely. Yeah. Without a doubt.
If we could get a little bit in a conversation about that, just to let people know how, how to understand that, because a lot of people just, they don't know. Our crowd, how they come to us. And, a lot of times these people are professionals. They make a lot of money, but still not quite savvy to manage money, basic stuff too.
Yeah. So most people, right, the average human being, they're exposed to the market through their 401k, their IRA, right? And most of the time, they're not picking individual stocks, right? They're more indexed, meaning the indexes are like the S&P, the Dow, the NASDAQ, which is just a basket of particular stocks, mostly the large cap stocks. And as they move in a certain direction, those indexes move in a certain direction. So a lot of employers offer plans when you have a split where you're exposed to the market that way. So when the market goes up, their 401k goes up, market and indexes go down, subsequently speaking, right? So, but just as a rule of thumb, the stock market is a discounting, it's a discounting mechanism, right? That kind of flows off forward guidance. So, they're not dealing in today's terms, right? The reason the stock market is tanking right now is not because, of where earnings and everything sit today. It's where they're going to see earnings in 6 to 9 to 12 months over the course of the next 2 quarters. And given the fact that it basically has brought travel and hospitality to a standstill, right?
Yes.
Because nobody wants to travel. I mean, airline stocks are getting hammered. Cruise lines are getting obliterated. Hotels are getting obliterated.
Gasoline.
Well, that's a different conversation. I'll get to that in a minute. But just to give you a point of reference, the ones that are getting hit so bad is because they know that the earnings aren't going to be high. So what do? They have to reestablish a value of what that stock's going to be worth if their earnings go down. So they scale it out about 2 quarters, and they say that this stock's probably worth this amount. So at any point in time, when you see the stock market at a certain price, that might be today's price, but that's discounting for 6 to 9 months in the future of what they anticipate the earnings are going to be. It's not ever in a moment-to-moment scenario. Okay. So when you see situations like what's going on now, it's because you're seeing repricing. When you see a stock market down 2,000, today was a convolution of things. It was, coronavirus still lingering around, and over the weekend there was a bunch of more, craziness that went on. But it was also as a result of, the thing that went on with oil and the fact that the Russians and Saudis are effectively having a price war right now, and OPEC is fractured. And as a result of that, now you got 2 different black swans kind of working against the market, which, obviously in those particular situations, it creates more indecision and more uncertainty. The market despises uncertainty. And as a result, you see people sell. When people sell, the VIX goes up. And the VIX is up at, and all this stuff is all painted everywhere. I mean, you can't, like I said, it's like the hurricane time, down here in Florida when hurricane season comes around. You can't go anywhere without being reminded of it, right? So every place you're looking, you're being reminded of. So the mania just gets worse. You go online, you get on television, every channel's talking about it. And nobody can give you any details on the coronavirus. Nobody. They got doctors for days talking about it. Nobody wants to give you any details. Nobody understands, or maybe they do and they don't want to tell you. Who knows?
Correct.
But there's no specifics. There's nobody walking it back or trying to dilute it a little bit, right?
Correct.
So it's just exacerbating everything like exponentially more than you could probably even predict for something like this. I mean, this far exceeds, in this short a period of time, this far exceeds what you saw with any of the previous, like SARS, or as far as I'm concerned, SARS or any of the other similar, pandemics that broke out, as far as how aggressively and how quickly this thing has really taken shape. And a large part of it is because there's algorithmic trading, right, which is just machine trading.
Yes.
So, that a lot of this just, you see these 2,000 point down days. That's not human beings doing that. I mean, that there's no way they'd be able to. Overnight, it was down. When the market opened yesterday, was at 6 o'clock. It was, the futures market was down 1,000 points. There's not enough people trading them for it to be down 1,000 points. It's all machines. Okay. So, they work in both ways, though. Like if you watched last week, there was a day it was down 11, then it was up 12, right? Then it was down 7, it was up 1,000.
Well, they say that Donald Trump came out and he mentioned, that everything's gonna be good. Then the next day it went up.
Yeah, but he doesn't. Unfortunately, that's. I mean, he's kind of lost that control over the market at this point because he doesn't have any more levers to pull to fix it, right? So, I mean, there was a point in time when there was levers that he could pull to try and facilitate it. But you're dealing with something that is far outside. If you're dealing strictly from the coronavirus perspective, I mean, you're dealing with something that's out of his control. But here's the rub. The rub is that China's already back in business. So China literally 8 weeks was in and out of this, and they're already back producing. They got people back at work. They're back in business. So the crazy thing, though, is that, despite hearing this, the media is kind of keeping all that information down, and we're not getting a lot of flow through on that. Why, I don't know, but whatever the case may be, there's not a lot of flow through showing that 8 weeks they're in and out and they're back to work. Now, granted, that's probably not 100% back to work, but if you were at 0 2 weeks ago and now you're at 60%, that's a pretty significant turnaround, right?
Yeah.
And that, if this thing has a life of 8 weeks, it would tell you, okay, you know what, America, if you can't go to the extremes, that China did, but, maybe you're a little bit diluted in the scenario. Maybe you're, 10 to 12 weeks in and out. Well, that gives you an expectation, right? And the market starts to adjust for that and how it's going to affect earnings and things like that. But, I mean, I think when it comes to, there's just been a lot done hastily that I think that they were hoping it would change. Now, I think when it all settles itself out, I think we'll see over the course of the next week. I mean, it's still discounting right now. I mean, I checked before we got on this call, and it was down again. It just reopened. The markets closed after 4, and then they reopened back up the futures market at 6, and it was down again when I opened it back up. So it's still dumping out. But I mean, at some point in time, we're going to hit a point where the market agrees that this is budgeting in the worst case scenario as far as earnings, and everybody's assuming zero growth. And when they say growth, when they're speaking about growth, they're talking about the GDP, the gross domestic product that comes out, and that's just accumulation. So typically last year was like a 2% growth number. This year they were hoping for 2.5, somewhere in that general range vicinity, and now they're budgeting for 0. So they have to scale back all these different variables, and that's why you keep seeing them dump out, and certain industries getting worked more than others. So I mean, the thing that it affects credit, though, when you get into there's two things. One, there's a thing called a wealth effect, right? The wealth effect is that, and this goes for anybody from a trillionaire down to somebody who's just got a little amount of money in the market. When the market's up, the wealth effect suggests that, when the market's up and it's continuing to run like a bull market like we've been in, people go out and spend more. The consumer spends more because they feel wealthier, right?
Correct.
And the adverse to that, when the market's dumping like it has been, people do the exact opposite. Now, keep in mind, a lot they don't go out, they don't spend money, because in their mind they're losing money, right? Even though it's paper money, and in a lot of cases it's a 401k that they're not going to tap into for 30 years, it's a psychological scenario, right? And this is if you look up wealth effect, you'll be able to see And that's a lot of the reason why, you know, you'll see people take losses and just sit and hide in a corner and wait till everything passes, right? They won't go out, they won't spend money, etc. So that puts more pressure on an already pressured environment. But when it comes to credit and stuff, when, like, for instance, the Fed cut 50 basis points last week, thinking somehow, some way that was going to fix anything, and all it did was exacerbate it, because it had nothing to do with monetary policy. It had everything to do with a biochemical problem and you know, a virus that has absolutely nothing to do with policy issues. And as a result, you know, them cutting that, it dropped the market, right? But the good thing is that when they did drop that, obviously that lowers the borrowing costs for the lending institutions. Now people are just flooding back in and refinancing their houses, right? Yeah. Because now they can get their interest rates lower. I checked earlier today, because the 10-year Treasury right now is at a 0.5 percentage point, which is just obscene. It got down to 0.4 last night. But when I looked at the 30-year on, I think it's floating at a 30-year fix, talking about almost 3.25. And you can get I saw a 15-year under 2, and I saw a 7-year ARM at like 2.3 or something, which is insane. Like that's insane. I mean, that's so low, it's insane. I mean, there was a thing today saying how mortgage companies are having trouble keeping up with all the business from people trying to refi, because they're jumping on this opportunity, right? Yes. They're jumping on the opportunity. They know how long it's going to sit down here, although I think it's going to be down here for a while. They're not sure how long it's going to happen, so they're trying to hum on it, which I get and I understand. But here's the other end of the spectrum. When you're dealing on a secured level, like a mortgage, right? That's a collateralized property, right? So the bank has recourse if somebody doesn't pay, et cetera, right? On the other end of the spectrum, when you go unsecured, loans, lines of credit, credit cards, et cetera, in times like this where the economy is contracting, meaning it's getting smaller effectively if there's no growth, banks start to contract their balance sheets. It's not something that they individually control. It's just how their models are set up. Okay. So if the United States government is growing at 2.5% a year, they're going to grow their balance sheet at 2.5% a year, roughly, give or take, right? I mean, I'm using round numbers. If it contracts, or it's, you know, the idea is going to contract 2% a year or this year, then they're going to start to contract the capital that they're lending out, and those particular risk models are going to focus it strictly on the unsecured side, because quite honestly, that's the area where they have the most exposure, where they can sustain the largest losses, right? With no real backup, like you would have in the event of a collateralized debt, like a mortgage, or you would have in an auto loan. Okay. So, and some other, obviously there's other debts you can collateralize with other things, but just for the most part, you know, a lot of the people that come through us do a lot of unsecured stuff. And as a result of that, if this sustains, you know, if this goes from, you know, just a really aggressive pullback, which right now who knows if that's what's going on right now. But if that's what it ends up being, and then, you know, we find a footing and we head back north, then that's one thing. If this thing continues to pull back and then happens over a sustained period of time, there's a really strong probability you're going to see those capital flows into personal markets, like individual markets, like, you know, retail consumers. It's going to contract exponentially, and you're going to start to see, you know, you're going to start to see less lending going on the unsecured side. You're going to start to see them clamp up, just like they did in 2008, just like they did in 2009, yes. Just like they did the last time we ran into a situation. Because quite honestly, the stock market is where they capitalize on everything, where everything gets contrived. Because quite honestly, you know, you look at their market cap of those institutions are determined by the stock market, right? In a lot of cases. So, you know, they're borrowing in some cases off that market cap. When that market cap cuts in half, it obviously eliminates some of their borrowing capacity as a bank in order to turn around and relend that money, right? Because there's certain ratios that need to be in effect as it applies to the Fed and such for them to be able to do that. Yeah. So, you know, with that in mind, when you start to see these pullbacks, it is a trickle-down effect that goes from the stock market being, let's just say, the top piece to everything all the way down to the banks, to the businesses, to the consumers, et cetera. And, you know, with businesses, small businesses, even medium and large businesses at this point, it becomes a situation of they're the kind of institutions that need more regular capital, right? But when you see a situation like somebody needs to go get an SBA loan or something like that, yes. This will directly impact that, right? Badly. Like, you know, if this sustains. I mean, I don't know how many people that follow. Some people were paying attention to the market back in 2008. Some weren't. Some learned about it from the internet, some whatever. But the reality of the situation is back in '08, when the market collapsed, it was a banking issue. It was a banking related issue. They were over leveraged. They weren't properly capitalized. So when the market dumped, the banks were the ones leading that dump, which was scary because obviously it was a situation that everybody had their money in the banks, and you didn't know if the bank was going to make it. They were merging large banks, etc.
Yeah.
Now it's obviously a totally alternative situation, but you're running into the same issue that could potentially present itself, where you start to see the credit markets freeze up because nobody wants to take risk, right?
Nobody wants to take risk, but the money's cheap right now. You're saying because the interest rates are low.
I'm saying it's cheap, but it's cheap. It was cheap back then. Like we cut the borrowing. The Fed back in 08, 07, 08, 09, the Fed cut the borrowing. The Fed funds rate was at 0. They had to cut it all the way down to 0, and we were still dumping like an anchor, right? Just because the rates are low, it is cheap and it's good borrowing, but the banks clamp up.
Okay.
Because they don't want to turn around and lend in an environment where it's contracting to that degree. And if it's happening very quickly, like it is right now, you're going to see them on the defensive because they're not stupid. You know what I mean? They're not morons. They're not going to be out there paying the streets with money. When a lot of these companies, you don't know if they're going to make it when the tide runs out, right? When you see a situation where, like I said, you lose 20% in the market in the course of 12 trading days, which is effectively 2 weeks. That's a you go from a bear market to a recession in 12 days. It's insane. That's insane. A recession is defined by 20% down from the highs. We literally hit 20% today in 2 weeks. Not ever did. This is the largest down trading day in like 20 years. So the point I'm trying to make is not to scare. I'm actually astonished at what exactly has transpired, and I don't think it's going to slow down the mortgage side of things, and I don't think it's going to slow down the auto loan side of things. And I honestly don't think on the unsecured side it's going to do a whole lot in the near term. If this is something that sustains, though, that you see potentially rolling out month, 2 months, 3 months, and it continues to be this sustained down leg, that's just an unfolding of positions.
Yeah.
That ultimately continues to leg us lower. I can almost guarantee you're going to see, especially if it keeps getting done this aggressively, you know what I mean? Like where the banks can't catch up to a lot of this fallout. And, especially just keep this in mind, going back to talking about the oil stuff from earlier, you get to a situation where, when oil prices drop like that, I think the break even for a lot of these smaller refiners is like $50 a barrel, something like that. Meaning they don't make money unless oil's over $50 a barrel. Today it closed, I think, at $31 a barrel. Oof. So, you're talking about a situation where how long can oil companies sustain that? And oil is the most leveraged credit and debt market industry in our entire economy. So you start thinking about the amount of losses that some of the big banks are going to sustain if, in fact, oil stays this low, or if it becomes a sustained scenario. And then you're going to start seeing that there's going to be these things that present themselves in the economy and end up being like huge problems, right? Like enormous problems that can get bigger. So I think we're all hoping goal-wise that this thing passes and it evens itself out and it alleviates itself without having too much craziness go on any further than we've already experienced over the last 2 weeks, But I would say for anybody that is trying to just prepare accordingly, if you can, I would, because rates, they're just not rates from a borrowing perspective. Rates aren't going to go to 0, right? Like rates will go to 0 from the Fed funds rate. Rates will go to 0. Potentially getting T-bills and things like that. It's basically like that, and that's not, it doesn't even track inflation anymore. But as far as like us borrowing, there's always going to be a borrowing cost there, right? And it's probably not going to get that much significantly less than where we're at right now, because the banks still need to make money, right? So it'll get lower, but it's not going to get much lower. So you're starting to bounce around near the bottom here. And I'm not talking about auto loans, I'm talking about mortgages. And I'm talking about, other fixed forms of credit, not ones that are variable like auto loans, where we've already talked about people get kind of get taken advantage of there and things like that. But in other areas, I don't think you're going to see credit card rates get lower because of the risk associated with it. School loan rates aren't going to, because they're tied to a different denominator that they arrive at their rates on. So for the United States government, it's great that their borrowing costs now just, you know, they're still lending at the same interest rate, but they're borrowing now at so much less, right? Because
Yes.
on a 10-year, think about it, on a 30, I think today the 30-year T-bill closed at like, I don't know, 0.8. That means they're paying out 0.8 of 1%, so 80 basis points they're paying out to lend out at like 6%. It's crazy.
So you're saying this is, I got a question. Basically, this will be the best time to borrow, Manny asked.
I think if you're playing defense, meaning like if you're trying to get out in front of what could potentially transpire, and you want to avoid the potential of the markets freezing up and things starting to contract, and not put yourself in a position, then I would say, yeah, it would make more sense to secure it now. You just don't know, and there's no downside to it either, right? So if you do it now and you secure it now and you get it in your possession now, then you don't have to worry about doing it later. But let's just say for some reason the market rallies and everything settles itself out over the next couple months, and you know the scenario that I'm saying could potentially occur, but that I'm saying does not occur. Then what did you lose at that point, right? All you did was provide yourself an insurance policy by getting it in advance before things really hit the wall, and then this way you were able to hold it on the way down if it did hit the wall, and if it rallied, then you had it anyway. So I mean, I just think that it's probably better to always weigh on the side of caution, especially when you're dealing with finances. And I think the side of caution would leave you to probably do it sooner than later. And again, on the unsecured side, you're not going to get much cheaper. It's really not going to get that much cheaper. Now, on the mortgage side, it could tick down. I don't think it's going to tick down much more than this. I think lending at a 7-year arm at 2.25%. You know, I don't know where the bank's making any money than that loan. I got to tell you, I mean, they're making a hair. So I mean, I don't know how much lower they can get there if you really do the financials and you put pen to paper and try and see where they're making money. So I'm telling you that banks make a lot of money on the credit cards. Banks make a lot of money in the auto loans because of what we've already discussed in previous podcasts about the
how they lend and everything.
Correct.
Yes.
How they're lent out. And they make a lot of money on the other loans, the unsecured loans, and there's a lot of risk caked into them because of the documentation they require. Obviously, default rates are high associated with it. So, I would say, yeah, if you can, I think it would be wise for sure. I mean, you just don't know. I mean, I was under I figured last week would have been the end of this, at least the disconnect, where we would have found a floor on the coronavirus scenario, and it just seems like it's continuing to pick up steam. And look, This could be the last week we talk about it. This could be a midterm bottom, a near-term bottom that we have over the course of this week. But in any event, you know, even if we bounce here going into the end of the week or into next week, there's still going to be drawdown going forward because the earnings are going to represent themselves. And if people start to stay home and they stop spending, because our entire economy over the last 4 or 5 years has been almost entirely relying on the consumer. Like we're not out producing new things. I mean, our major companies. Look at the major companies in our society that we bank on. You know, Amazon, Apple, Microsoft. You know, Tesla. It's all consumer driven.
Yeah.
It's all the consumer. It's it. You know. Service. So I mean, you start getting people to pull back from spending and tighten in their bootstraps, then you know, I mean that becomes a very, very big problem for corporate America, right? Especially, you know, again, look at Walmart. Look at some of these companies whose stock has just gone to the moon, you know, over the last 4 or 5 years, strictly based on the consumer spending, you know, and their ability to. Personally, I think it's more as a result of people coming out of 2008 and being, this is my opinion, more fiscally wise, so they're leveraging more properly, whereas maybe prior to that they weren't properly leveraged. I think now people, just seeing people's credit files every day and being able to see, I think now they're more properly levered. But I can also very easily see, because I think we're just smarter as a society now than we were back in 07, 08, or 09. I could easily see people saying, "Nah, man, I ain't spending," you know, because you just don't know. You just don't know. And I could easily see people cutting back. And as a result of that cutting back, I can see if this continues to persist, you could see, you know,
But we're getting busy. I think we're getting an influx of business. Like people are like, I need to do something. I mean, if they go through this coronavirus stuff with bad credit. And
yeah, but but that's not to cut you off, but that's a completely different topic, right? That's a different lane, because it would make sense for people to want to clean this stuff up now, right? Walking into that scenario, right? They're not going to walk back and be like, all right, the world's collapsing. Let me just collapse with it. I just don't think that's the mentality, right? I think if you're smart, you're positioning yourself now because they'll present themselves. Let's just say, look, right now, and it's been an understood fact. Okay. Because interest rates have been so low for so long that asset prices are just absurdly inflated, right? Real estate prices. We talked about this with Carmelo on the last
real estate podcast. Yes.
Yeah, the asset prices, all asset prices are inflated. I mean, real estate prices are so inflated in every major area you're in. You know, stock prices up until the last 12 days have been absurdly priced. You know, sitting at its highest point, all because interest rates are low and you can't get any kind of a fixed yield anywhere, right? But now it's pulling back, and if it continues to pull back, you can see asset prices come with it, like stock prices and ultimately real estate prices. Because what ends up happening with real estate is that the banks make it harder to borrow, right? And when the banks make it harder to borrow, people that are selling their houses ultimately end up dropping the price, and boom, there's where you sit, right? So it starts to pull real estate prices back with it as well. They become opportunities for people. Well, you're not going to be able to get in there if you don't have good credit, right? So, I mean, it's a pullback if it does materialize on a broader scale. It's a pullback that a lot of people have been waiting for a long time. If it doesn't and we continue higher, then even better, right? I mean, I think that's the goal. I do think, though, ultimately, when it comes to real estate, that there will be much better buying opportunity in the future. If it doesn't end up being this time, it could be, down the line. But real estate prices are far too inflated, and it's a large part because interest rates are so low and people can borrow cheap. And, this is where we sit right now. So, I mean, I think that I think any way you twist it, I don't think anybody wants to see it dump much more, but it's starting to make opportunities. And I think in order to capitalize on those opportunities, smart people are positioning themselves now in order to try and acquiesce that.
Somebody commented, so convert all cash and credit to gold market, ?
No. I mean, look, you should always have a certain amount of gold in your portfolio, right, as a hedge. But gold right now is trading really high because it's been the hedge for everybody for the last 6 months, right? So, I mean, you'd be buying at a high right now if you did. So if things happen to reverse tomorrow in the market, you're going to get torched. If you do need to expose yourself, I wouldn't look if you go all cash. And even Bitcoin dropped yesterday. I mean, it tanked to like 7, and that's been a nice alternative to the market. But I was going to say, even if gold does pull back, you should always have a well diversified scenario, and a certain 5-10% in gold should be what it is because it's a hedge. It's a washout. I wouldn't take everything and do that because there is a very strong probability this could reverse, and then you just dumped all your money, in gold, and then gold is going to reverse. When the market reverses back up, you're going to see gold go down. They work inversely like that. Gold is a insurance policy. It's a hedge to the broader market. When people think it goes back to the old time, back in medieval days, even earlier, people, when the one thing that mattered was tangible gold, right? People paid with tangible gold. So when, effectively when the stock market goes to crap, people think gold, right? Because, that was the methodology. So that's effectively what you're going and you're turning to, is the idea of gold as a safe haven relative to some of these more speculative scenarios. So no, I wouldn't say liquidate everything and do that. I would say monitor it. If you don't have anything in gold, you probably should have a small percentage of your overall portfolio in gold anyway, just as a hedge to the broader market. So on down days, you don't get beaten so bad or as badly. But no, I wouldn't liquidate everything. I think that's excessive. I think there's easier ways of diversifying so you don't have to do that.
Yeah, no, people are saying line up the credit and take advantage of opportunities.
I think that's more what I was saying earlier. And I think preparing yourself and getting everything in line and just sitting back and being the smart one this time, not the one getting taken advantage of, which a lot of people were had back in 07, 08, right? They were the ones that were getting served up, and they looked back after the fact and they said, why did I do that? Why did I do that? Now this is a good opportunity for people to position themselves and buy on a pullback intelligently. And, obviously start to capitalize on some of the opportunities that are going to present themselves now. And you got to understand something. The stock market can reverse 20% in 12 days. The real estate market is like moving an aircraft carrier. It does not happen overnight. The same way it takes months and years to build up a gentrified neighborhood, or to gentrify a neighborhood, to build up a dilapidated neighborhood.
That's true.
It takes some time to unwind on the real estate side. So if for some reason this happens to be a sustained pullback, like I was saying earlier, don't jump on the first low price you see, because that low price could continue to drop if things continue to stay on that way. Because I saw a lot of people do this in 08, 09, 07, first leg, first dump, people were buying because they saw it as a legitimate pullback. And look, like I said before, and I repeat, there could be support here, and this could all wash itself out over the next week or so. And, I'm just saying that if it ends up being sustained, there's going to be opportunities. And with those opportunities, don't always just jump on the first one, because it could be another leg lower. You got to keep in mind a lot of the other fundamental factors going on. I mean, if you can buy on any kind of pullback over the course of time, it'll work itself out. You don't want to buy at the top. Obviously, you want to avoid that at all costs. But, definitely what they said earlier, whoever said, load up, get all your weapons ready, so when the opportunity presents itself, you're ready to go, I think is exactly the right mentality.
Yeah, no, some people are saying
playing offense, but playing offense defensively. You understand what I mean? So You're not out there being aggressive and stupid about it. You're playing offense. You're sitting there back, ready to strike when the opportunity comes, but you're going to wait for the right piece of meat to fall in your lap, right? You got all the weapons necessary.
So with China, Italy, all these places that are like, I mean, only a certain section of the economy is getting hit. Let's say with Italy, a lot of tourists, right? And let's say with China, a lot of Chinese travel too. But you think this is kind of like a global type of thing, global recession that may happen? Because
you got to understand, the every other country other than us and China are effectively lending at negative interest rates. Their government bonds are, and sadly over the last 12 days, ours have gone from like 1.5, our 10 years gone from like 1.5 down to 0.4%. But effectively, they're when you like the Bund, which is the German T-bill, right? Which used to be a point of measure, as far as it used to be just as strong as the United States Treasury. Their rate right now is like minus 0.1 or 0.11, something like that, right? That was the Bund. The point I'm trying to make is they've been in a global slowdown. We just haven't been with it for the last year. They're just getting affected now because our country's so big that it's, and we have pieces in every other country that when we start to dump, excuse me, they all get affected. Especially when it's something like this, where it's, largely travel oriented. Look, the oil thing's going to affect everybody, because oil is a mainstay in every society, right?
Yeah.
Every developed society has oil in it. And I'm not saying that oil is now what it once was before, as far as, or where the puck is going in the future, but it still has an absolute mainstay in everybody's society. So when you see oil drop, what was it? Geez, it closed Friday, I think $48, $48 a barrel, and it opened today 32. Do the math, right? So or finished it, closed at 32. I mean, do the math. It was a torture day. So I mean, a large part of the move today and the exacerbated element to it was the oil. So when that starts to stabilize, you'll see the broader market stabilize. But there is still the remnant of coronavirus. Now you got two things running at the same time. But here's the thing that you see that people don't understand about China, and maybe they do, and they just don't understand why. So China went through last 2 months, January, February, end of December, I think, January, February, with this whole coronavirus, full force, right? They were locking people in room. They were throwing all people with the virus in these buildings and just basically sealing the doors, right?
Yeah.
They had doctors in there, and they just didn't want them getting around other people, right? Well, you say to yourself, how is it that China escaped their market dump in 30% in 15 minutes, right? And if you ever look at all the Chinese-related stocks on our exchanges, Luckin Coffee, Baidu, JD, all these other ones, Alibaba, they didn't drop. You ask yourself, how did that possibly happen? How are we getting towards the exact same thing? And China is a communist government, so they come in and they prop up their economy. financially. They come in and buy equities. They prop up their indexes. So the reason you didn't see the same carry forward with them, and you're not seeing it when we drop, is because they come in and they prop their economy up. Their government buys up their stock market. Their government does everything to keep their government propped up, to keep their whole civilization propped up, right? To give the impression of prominence, of dominance, right? At least that's how they want to project themselves. So for the people that are invested in that, that market, it's enormous, right? It's great. There's limited downside, right? Because that's how, on a broad scale, that's how the globe measures in large part, to a certain degree, dominance is how well your economy holds up. And the stock market is the number one, almost largest indicator of the economy, right? Right, wrong, or indifferent. So that's why you don't see China really that affected by it as far as an economic. Italy, I mean, look, without going through every single country, it is a larger country, but I mean, they've been fraught with problems. They're over leveraged. Their banks are over leveraged. I mean, their entire economy is fraught with problems, and it's always been fraught with problems as far as I'm concerned. And most of Europe is as well. So you're going to see that unfold over the course of time, right? And that needs to and needed to unfold. So it was a matter of time before even a small thing could have tipped that in that favor, right? I just think that was inevitable, and it's always been inevitable, and it's just the way it is. I mean, if you go back in Europe, excuse me, if you go back in Europe, 5 years, it was Greece before, right? You go to some of these beautiful places where their economy is almost entirely driven by partying and traveling and everything like that, right? And there's really isn't much to it other than the beauty of it. It's not surprising that the economy struggle, right?
Yeah.
Because who's out there hustling, right? On a broad scale. I mean, just take it from a very simple fundamental perspective. I mean, it just doesn't work like that. So as a result, you're seeing them have problems, and a lot of the other European countries have problems too. But it's not. It's more we're the leader, and they're kind of we've been fighting through as a result of the consumer, like I was saying earlier, over the last however many, maybe 3-4 years, the consumer's been carrying this last leg of the bull market. And, as a result, we've been keeping them propped up because there's products from those countries that exist in our country, right? A lot of products from Europe, a lot of products from China that exist in our country. We can help indirectly, we can help keeping them propped up. Well, as things start to pull back, they're going to feel it just as much. So no, I don't think it works. I think it works one way in that, we haven't been attached to the global slowdown, but it's now starting to appear as though
so someone said over here, virus could hit baby boomers hard. Flooding market with housing? ?
I mean, you're going baby boomers, so
let's say coronavirus is hitting more.
Yeah, no. I understood the question. I understood the fact that based on the limited amount of news we have about the coronavirus, the idea is that the people that are most impacted and affected by it are the elderly, right? So I understand that. I also understand the thought process behind if they're the most affected, are they going to be selling properties, or if something happens, etc. I just don't see that being a knee-jerk reaction, and I don't think they're going to be the ones that are, because typically speaking, at that age you're not overly levered. Normally the younger ages are the ones that are overly levered, and they're normally the ones that get impacted the greatest in these kinds of a situation. Businesses and individuals that are just leveraged way too high, whether it be unsecured debt, whatever, properties, automobiles, just relative to their income. Same with businesses. They're the ones that you'll see the most fallout from. I think that from a property perspective, I think that there's just enough natural turnover that there'll be opportunities, especially as things start to pull back. So houses that were sitting, if it sustains, like I'm going to keep repeating, if it continues to fall, and this becomes, a year-long scenario, or 6, 7, 8, 9 months, we start to see things pull back. I think there's just going to be natural opportunities because people aren't going to be as aggressive to buy, and the same sources of capital that they once had aren't going to be there, especially from an investor perspective. So you got to understand, in the one podcast we talked with Carmelo, sometimes some of these private money companies are out, that do a lot of these renovation to perm loans. A lot of times it might be capital they raised, or a lot of times it may be an institution that they're borrowing from, right? They're building their own yield spread. So they go to, let's just take for argument's sake a hedge fund, private equity company. They say, listen, you know, they have a track record in lending and they want to raise their own funds. So they go get $20 million. Well, they're borrowing from that hedge fund because let's just say the T-bill used to be about, the 10 used to be 1.5. The hedge fund say, all right, well, we want at least 4%. You know, that's what we want to service the debt on whatever's outstanding, et cetera. So they'll turn around, those private money lenders, and they'll lend it 10, 11%. You know, they'll service it and they'll make the yield spread just like all other things we've talked about on these podcasts. So in situations when the economy contracts, those hedge funds start calling in money. I've seen it. I've literally witnessed it. I used to, back when I was buying a lot more back, around 09 or 10, 11, I used to deal with a lot of hedge funds back then.
Okay.
And you would see it when the market started to contract. Even they had, because they borrow, hedge funds borrow money from, so a lot of their investors are private equity and some are individuals, but in large part they're other institutions. It is a true trickle-down effect that you see that goes on. You see when that contraction occurs, that contraction works its way all the way down because the person that they're borrowing from wants their money back. The person they're borrowing from wants their money back, or they want to tighten it up, right? They want to lessen their exposure. It's the same thing I was explaining earlier with the banks. You see it everywhere. You see it everywhere when this stuff starts to take shape. So the point I'm trying to make is that the access to capital may not be as much as it is right now if things start to continue to contract, which means that there's going to be more opportunities. When I say access to capital, I mean like I was saying, like hard money lenders, private money lenders, et cetera. Now, there are a ton of them that have their own capital. Don't misunderstand me. And they lend their own money, and that's the end of it. But an equal amount of them are people that are like I'm describing. In order to get into the 10s, 20s, and 30s, and 40, and 50, and $100 million type operations, you're borrowing from somebody in almost every case because the people that have that sitting in the bank aren't out there, fighting with people over collecting on a $60,000 renovation loan, right? It's just not happening. So they're basically lending it out in tranches to different places that are trying to get them a yield. So when you see pullback, they want to pull their risk off, and you see it work it all the way down. So I would say, as a result of that, you're going to start to see, if it continues, you're going to start to see prices start to come down on their own. But I honestly hope that we, we're just hitting a bump here and that we rally from here on out and things start to regroup. But the purpose of this is just to let people know so they understand what options they have, right?
Correct.
Like let's just say it continues to dump out. We're working towards giving you a good idea of how you need to proceed with it, how you need to approach it, and what you need to do. If it rallies, then look, one of these days we're going to get a pullback. It's inevitable. And I like, 20% in 12 days is insane. I mean, pre-algorithmic trading, it would take like a couple years to lose 20%. We did in 12 days. So, it's hard to believe it's happened, but it's even tougher to think that, when you go down 20% in 12 days, that there's more to go, but it's very possible. So you just don't know. And as a result of that, like I said, you just got to prepare yourself for both sides, right? The best way to avoid mistakes is to prepare, and that's exactly what the purpose of this podcast is: allow people the opportunity to prepare and to know what to expect.
Someone asked right now, Jay, sorry to cut you off. So do you think rental market will be affected? Will prices fall?
Absolutely. When prices fall, rents fall. It's just that simple. It's a direct correlation. So, the demand, when you start to see prices fall, the demand exists, right? It has to be competitive to a certain degree. You can't have a property that was once worth $800 that's now worth $500, and at $800 you were charging $5,600 rent, and the economy is contracting, and you're still charging that on a $500,000 property, right? There's just no way. It won't work itself out. It will naturally correct itself. It's not like something you're going to have to correct, right? You're going to ride out that $5,600 in rent or whatever we just said as high as you can, but you'll start to see the market and the new incomers in the market will start to drive it down, and it'll start to go down with the values of the property because it's all commiserate, right? The good thing about that, though, is for people that like to buy apartment buildings, if we continue to see it dump, and I love buying apartment buildings. If you right now the caps on multifamilies and apartment buildings are terrible. Cap rate on it. We talked about this with Carmelo. If you don't understand what it is, you can go back and reference it. But the caps are very, very low. We're in like a 4 or 5 cap environment, which is ridiculous. It's almost not even worth doing for the amount of risk you take on to and work that you have to do to maintain it. When values start to drop, those and rents stabilize. Doesn't mean that they need to tank, but if they start to come down a little bit, but the price of the property is dropping more aggressively than the price of the rent, the cap rate will go up, which will make it a more attractive property. So now you're going to get an equity play on it, plus you get the amount of upside on the rent potential when the value starts to regroup. So excuse me, it'll start to really present opportunities on that side of the table, because I think that side has been overly bubblicious over the last couple of years, just with all this other stuff going on. So I think I answered that question, but I do think that there will be good opportunities on the assuming it continues to pull back on the multifamily side and even single family side. But I mean, I just think there'll be more opportunities. I think we're naturally good for a pullback anyway, but I don't know if it happens right now. I could easily see, if somebody wants to hold me to it, I could easily see us find a footing here in the stock market over the next week, because I've been saying that week to 10 days, rally back up, and then then you start to see things unfold again, and then that'll be the more sustained move down. So, I mean, this could all take 4 or 5 months to actually materialize, like on the downside. But again, the purpose of this is just to prepare. It could also happen tomorrow. We could wake up tomorrow. Nobody anticipated the oil stuff was going to collapse like that. I'm just saying, if you ask my honest opinion, that's what my honest opinion is. I think we'll probably find some footing down here. We'll start to push back up from a market perspective.
Well, don't you think, just like communist China, don't you think we prop things up too? I mean, it can easily be manipulated. Numbers, job.
Well,
numbers,
I mean, prop up. I mean, look. So when I say China's propping, I'm not just talking about exaggerating their job figures. I'm talking about they literally invest in their stock market. They have unlimited amount of funds, right? So just imagine today. Today the market was down 2,000 points, right? 2,000 points. This is obscene. I mean, that is absurd. They would have bought that whole dump, and likely would have probably finished the day down 300-400 points. It means they would have. They effectively act like a market maker more than a market maker acts. So they are a backstop to prevent the appearance of a failing economy. Do you understand what I mean?
Yes.
So we don't. I mean, look. Does that happen? Who knows if it really happens in our economy? It doesn't happen to that extent. I can tell you for sure. Even if it's in a dark pool or not, it doesn't happen to that same extent. Because if it did, I can tell you that this particular presidency would not have allowed the market to drop 2,000 points today. I'll promise you that. In the middle of an election cycle, going into an election year, and everything like that. So if anybody has any qualms about whether that is a reality in our government, I can assure you that if it was going to happen, he would have already had it rally. We wouldn't be sitting at this point in the most pivotal time in his entire presidency, knowing that you're going into an election that's going to get decided in November.
I mean, that's why I asked if things are being propped up, to have.
If you want my honest opinion, I mean, again, I'm not like a kook, and I'm not paranoid or anything like that. But I think it's probably more on the other side at this point. So I think that you're probably a large majority of the media is controlled by the Democratic side.
Oh yeah, correct. Yeah,
and I think that you're probably, and I think that the Democratic Party knows that the one thing that Trump has more than anything else is he has this economy. Most people vote with their wallets. So if you can drive this economy down going into the election cycle and going into, when the election is going to take place, and people are sour right up to the moment.
Yep.
I mean, what better way to control the situation, right? I mean, you want to talk about making a level playing field that was once not so level. Correct. I mean, you just did it real quickly. So I think in that regard, I think without really needing to use my imagination too much, I think that's a possibility. What I just stated, especially given the fact that the amount of pandemonium and lack of information that's coming out of this whole virus scenario.
Scare tactics by the media?
Absolutely. I mean, this is an opinion, and this is nothing to substantiate it. I just find it really odd that we're here 3-4 months into this since it started with China, and the only thing we know is this cold and flu-like symptoms, and that it's very fatal, or it has a high fatality rate among very old people. Now, I mean that to me sounds very, very general. right? I mean, for a situation that's been in our country, we have, I believe as of yesterday, we have hundreds upon hundreds upon hundreds of cases in our country that are being reviewed. I find it odd that they don't have any other details on that, right? And why they're not being submitted. It just seems very peculiar to me that we're literally being left with zero. They got people out in boats off the side of the, and crews. They're not letting them off. They're treating them like criminals. I mean, it's crazy. It's just crazy. The whole thing is crazy, and it explains why there's just this degree of pandemonium. Because if you don't give people, as consumers, we're expecting we want to be spoon-fed information, right? I mean, literally, we wake up, we turn on our phone, we get information. Turn on TV, we get more information. We look over at our iPad, we get more information, right? We log on to Facebook, Twitter, etc. We get more information. It's all information. We're so flooded with information. It's ridiculous. I mean, we got more information of nonsensical, stupid things than we do of anything of substance. Here we are in a situation where all we want to do is get an ounce of information, and we can't get it. It just seems really, really, really peculiar to me that there's not even a small degree of any kind of delineation that exists. But whatever the case, it is what it is, and this is where we're at. So hopefully and that's not to take away from the people that were impacted. It's terrible to hear people who are
news is definitely rallying, and news is definitely making money. Because that's what you.
Oh yeah, listen. You gotta understand that's advertising all day. Again, I see it with the hurricanes down here.
Yeah.
You start getting stuff like that. The ratings go up when ratings go up. Advertising goes up more. Especially with the ratings going up, more people want to put ads on.
Oh yeah,
where you make money.
Correct.
So it's a very, very big money making machine. But as it ties back to this whole thing with the market, I think that I think that that's why I'm saying that I do think that, again, this is my opinion. I do think that we'll find a footing here in the market over the next week to 10 days, and we'll start to push back up, probably up around, what are we at right now, 23. We'll probably get up to around on the Dow, maybe 27-ish, 27, 28, and then that should probably put us somewhere in, what are we, maybe May or June by the time we get back up there, right? Just in time for them to drop a bomb, not a legitimate bomb, but like start to push this whole agenda again with the whatever new thing is existing to go right into right when they're going head to head with whoever the Democratic Party comes in. I could easily see this thing get ugly quick there, because what better way to level the playing field? I mean, if I was a think tank in Washington, I mean, they've tried everything else. They tried to do all the other things to get them out.
Yes.
What better way to just completely devoid of any kind of obstruction? I mean, that's the way to do it. If you're controlling the element, I mean, what better way to do it? It's genius. If that's what's exactly happening.
Yes. No, most definitely. Someone just said right now the best time. Oil war came at wrong time.
What's that? Oil
war came at wrong time.
Yeah, absolutely. Came at the wrong time. Or if you're on the other end of the conversation and this is all some kind of a cohesive scenario, it all came at the exact same time for a reason. But I think that the one conversation you'll get from the administration is that lower oil prices mean we pay less at the pump, right?
Yeah.
The problem is the rub to that is that everybody voluntarily is in the 401k, right? So I mean, you're trading off one for the other, right? I mean, you watch your 401k get torched, and now you're paying 15 cents less at the tank. I think the people would probably rather have their 401k propped up than the tank, but he doesn't control that, unfortunately, and that's why he's trying to find a positive within the conversation. But it definitely dropped it wrong. Or again, it could be the alternative to that is that it's dropping now, and hopefully that'll help eliminate something from happening when it was finding a footing, so that we can rally here and we can get it all out of the way and throw all the crap at the wall, so that everything will get baked into the price, so that any new stuff that comes out from here on out.
Someone just said right now, Louisiana and Texas lost jobs at $50 a barrel.
Yeah, no, that's what I'm saying. $50 a barrel. That's what I was saying earlier. $50 a barrel was like, blended. And this is the big boys too. These are the big guys too. This isn't just the small refiners. The big boys. $50 a barrel was about right for like where their break even point was. So I mean, when we stopped getting above $50 a barrel, they start hurting. The problem is like I said earlier, the oil business is so heavily levered with debt and credit that if you're a smaller company and you literally were just continue to roll over debt and you can't, you're not getting back above 50, what are you going to do now that you're at 30? I mean, you got such a far tranche to get back up there. I mean, it's going to be a lot of problems if this doesn't rally back quickly and they don't come to a resolution. It's going to be a big problem over the next. Like I said, I mean, the markets going into the beginning of the year were so calm. I mean, the VIX would sit at like 11, which you didn't ever see. Okay. And then the beginning of the year, and again, remember I said the VIX is just it's kind of the fear. They call it the fear index. It's goes from 0. I think the highest reading ever has been like maybe 100, something like that. And it's happened maybe once. The financial crisis got up to 80. We've gotten so far on this up to 60 some. And that was today, which is ridiculous because it's nowhere near the financial crisis. But it's just a fear indicator. And it was sitting at like 11. It was like sitting 11 for like 3 months. And even through the trade stuff with China and, just because there was a certain degree of certainty that existed in the market. And, since then, it's just been haywire. And as a result, what comes with that is just massive moves. And the moves are exacerbated and, with the machines pushing, and it just makes it work. I mean, with Texas, Louisiana, and they said North Dakota is another one that's really going to take it on the chin. So a lot of these states a lot of their income and economic activity derives almost entirely from drillers and refiners and frackers and everything like that. It's going to be a lot of problems. I mean, look, even if this market rallies, if oil stays this low, they're in trouble, man. I mean, it doesn't matter if the stock market rallies. If oil stays low, that doesn't help them. So that's going to be a lag. That's going to be a tailwind regardless if oil doesn't rally with the rest of the market.
Truck drivers, all that stuff.
Well, look, truck drivers are good, right? Because now they're paying less for oil.
Correct.
I'm paying less for gas. So for them, that's actually a good thing. But for I'm talking about for like the oil companies that are pumping it out of the ground, right? The ones that need to get a certain price, that they're pumping, they're refining it, they're doing everything. They need to get a certain price to make all the money for all the logistical and all the infrastructure they build to get this stuff out of the ground and to pay their debts at the same time. And then that price, again, it blended across all of them is like $50 a barrel. So, when you get into a situation where $50 a barrel, and we're at $32 a barrel, man, you got a long road to hoe. It's a long way to get there, and I think it's going to mean a lot more problems. I mean, look at the big boys. Exxon was down. I think Exxon ended down 10-15% today. Chevron, same thing. Wow. And keep in mind, Chevron, Exxon, BP. Who's the other one? There's a fourth, which is escaping me right now. They were all the original Standard Oil that John Rockefeller started.
Yes.
They back in the, I don't know, maybe the 60s or something, they split that up because they said it was a monopoly, that nobody could make money, right? Okay. It was probably before the 60s. It might have been back in the 40s. I don't remember when it exactly transpired. But they split it up, and they split up into 4 different companies, right, to make it fair. And they were the 4 companies. And obviously, they're still, to this day, it just shows how incredibly, big that company was. That's still now, so many years later, they're still the biggest parts of that industry. And that they're still in this kind of an environment, they're still the leaders in that industry. But the point I'm trying to make is they got dented big time, and they pay really high dividend yields. Exxon pays like 7% dividend yield. Real concerned that's not going to hold up because they don't know how much longer they're going to be able to hold out on that. So I mean, it's an industry that's in a lot of trouble. Let's just put it that way. I mean, very simply. I mean, it rally here or not. I think it's, the writing's starting to get on the walls and something's going to have to change eventually.
As a credit repair question I got from Lynn today. You remember Lynn?
Yeah.
She sent me a text. She was like, she said to me, An old credit repair client received this letter. One of the accounts attempt to remove. What does she need to do next? You know how you get those letters. Could be an advertisement, but it looks like a tax form. It says 2019 form 1099C.
No. That's not an advertisement. That's what happens now when you don't pay your debts. I was actually talking to somebody today about this. And you're seeing it more now than we ever saw in the past. But if, let's just say, for instance, you charge off a credit card with Chase Bank, okay, and Chase, let's say it's 15 grand. Chase sells it to a collection company. Collection company tries to collect from you for I don't know how long, right? You don't give them a nickel. They find no way to try and collect on that. They send it back to Chase. Chase typically, and this is like an actual scenario. This isn't like a hypothetical. Chase now will send out a last letter. They'll be like, listen, you owe us 15 grand. We'll settle this for 20 cents on the dollar. Give us 2 grand, split over 1 payment or 2 payments, whatever, right? It's just like such a sweetheart deal. What ends up happening, though, is if you ignore them, then they'll send you a 1099 for the full amount, for the full 10,000, using my example. And then you have to file it on your tax returns because effectively you borrowed it. You didn't pay any of it back, not even a cent of it. So in their mind, you have to take it in as earned income because you effectively didn't pay any of it back, right?
Wow. So this it doesn't say that. Oh yeah. It says here, amount in debt discharged $2,800. So
that individual has to file that with their taxes. And here's the kicker: if you don't do it, then they'll catch it because the bank submits it when they submit you your 1099. So when they send you a 1099, they send a 1099 to the IRS as well for you.
All right, hold up.
You understand what I'm saying?
I'm not the smartest when it comes to this.
Okay, so they just sent. Let's just say, using Lynn's example, a client of hers charged off a card $2,800. You understand?
Yes.
Okay, so and you understand my scenario, right? That I just painted with the other example earlier.
With the it's the discharge debt. So I have to.
Okay, so in this case, they sent a 1099 to Lynn's client because they tried to collect. They couldn't collect. They tried to, they sent it to a collection company. They couldn't. They tried to collect themselves. They couldn't. So they sent a 1099, which Lynn's client now has to report as earned income on her tax return for that year that the 1099 lists. You understand that part?
Because she didn't pay it, so she basically got free money.
Correct. And they're saying you have to report it as income, which is true.
When they didn't start doing this?
I mean, they've been doing. They're doing it more aggressively now over the last 12, 14 months. Things are getting a lot more aggressive now. You've seen a lot more aggressiveness. I'll get into that in a second. But the
okay.
But the other way they get you, though, is how like a lot of people will just say, "Oh yeah, I'll file," and they'll just ignore it, right? Thinking that the creditor there'll be no way that they'll be able to tell. Well, what happens is when the creditor sends you the 1099, they send the IRS a copy of the 1099 with your name, so you can't not file it because it's already on record. So if you try to avoid putting it on your tax return, they're going to reject the immediate return. They're going to send you back, listen, you owe us 30% on $2,800. So give us another $540 included on your tax return. You understand what I mean?
Correct. So if they're going to get a refund, let's say $2,500,
they'll make the adjustment. They'll adjust out the difference and they'll cut them the check for the difference and they'll send them an explanation.
All right. Let's say in this case, she has one kid, and the one kid, she gets $4,000 for that kid as a refund. But then this is attached to it, and it's $2,899, right? So
well, you're confusing two things, though. You're confusing two things. So what happens is you get for each kid you get a $4,000 write-off. That's not a refund. You don't get a $4,000 refund. You get to write off $4,000 per kid, right? So that comes off your taxable base. Okay, so your taxable base, let's say you made 30 grand, you write 4,000 off for that dependent, right?
Okay.
So then it goes from 30,000 to 26,000. So instead of, let's say your income tax rate is 20%, at 30,000, it's 6 grand you pay, right? Now you subtract the 4 grand at 26,000, it's roughly 5,200. So you save $800, right? By deducting that 4,000, it's totally different.
So it gets added to her gross.
It'll get added, correct. It'll get added to her income.
So her income. Okay.
It's an income line item. So rather than her making 30 grand, she's going to make $32,800.
And then they'll tax her on that.
It'll get added in, and it'll get taxed. There's an actual line item on your 1040 for discharge debt. There's where you can put it in there. But yes, so, it'll get backed out from there because it gets added to your income, and you get back into where you arrive at that point.
So now I got to tell her that she has to take it to when she does her taxes. How about if she already did her taxes?
Then they're going to send her a bill, and they're going to make her adjust it.
The IRS will send her a bill.
They will 150% with zero confusion send her an adjustment. So if she filed her 19s already,
yep.
Then what they'll do is if they caught it before, more than likely if she filed hers, if she didn't get her tax return, her refund back yet, which she probably didn't, if she didn't get it back yet, they'll send her the refund with the adjustment out. If they, for some reason, she was able to squeeze in without them noticing first, which I doubt happens or happened, then they'll send her a bill with the adjusted return because it's not the proper return either. So they make her adjust the return too, right, to reflect the proper numbers, because it's not effectively showing the right numbers if you're not adding in that 2,800 as income. Understand what I mean?
So no matter what, she's gonna have to deal with it.
Yeah, and they all do. And back in the day, it used to be the ones that was, back 3, 4, 5 years ago, it used to be the debts that were just the big ones. So somebody took out like a $30,000 card and then just screwed the bank on it. They would be the ones that they would send the 1099s on, right? Just because, the large amount of it, and the banks just weren't in that business, the loss mitigation side, that they really had a process set up to do that on a more consistent scale. Now you're seeing it more, and it's more regular, a lot more regular. And the other thing I've been seeing a lot of is I've seen Capital One lately taking people to court like crazy, like almost like they're changing their whole loss mitigation process, where they're just people that are charging off and are getting resold. They're taking them to court and they're saying, we're not giving these debts away anymore. 5 cents on the dollar. We're just going to start litigating them. And I've seen this over the last 3 months, and it's been pretty consistent. There was a sweep one week where I was on the phone for 4 days walking people through it. Because
by the way, just to let people know, we don't need to do this with you guys, but we do it because you call us crazy.
Yeah.
And panic. so
it has absolutely nothing to do with what we're doing for you. We just walk you through so you know what to do, so you're prepared, much like we're doing with this podcast in regards to the market and some of these other things. Correct. There's no personal benefit. We don't charge extra for that. It's just part of help and assistance trying so that you don't get taken advantage of.
Correct.
Or that you don't make the wrong decision, because not showing up at court a lot of times is the worst thing you can do.
Oh, yes. And we have found many people, who are afraid of that court situation, alleviate their fears. They go confidently and they come up with a payment plan, and it's all good. But I'm sorry, you were saying something.
No. I was just saying that, as far as the 1099 and stuff like that, I've seen it all, though, and I know how people think. And, there's just no way around it. That's why I was stressing the fact that they will absolutely send a copy to the IRS, too. We have to pay their share in that money. So, for the people that haven't gotten them yet or will be getting them, don't try and shortcut it, because you're just going to put yourself in a worse situation.
So now even these low debts, 27, 2,800, 3,000, before they used to sue you, Jay, and then you go to court. But I guess it's easier doing this.
Well, it depends on the lender. Like I said, you're seeing Capital One now.
Macy's, Jay? This is a Macy's card.
Well, that's Synchrony Bank.
Oh, that's right. You said you talked about that bank that they run all these.
Yeah, that's Synchrony, which is almost as bad as Capital One. On
Wait a minute, rates. Macy's probably American Express card, is that the same one?
Well, that would actually make sense if it's an American Express sponsored card. But Macy's used to be Synchrony, so I don't think I've ever heard of an American Express Macy's, but I don't have a Macy's card, so I'm not that versed in it. But most store cards, I know Macy's used to be a Synchrony bank card. Maybe they switched their sponsor to American Express. Whatever the case, it's it really depends on the lender and the amount, right? Now, Capital One, you would have to assume naturally that the average credit card blended across all the people that they lend to is probably $3,500, right? Because you got to figure all the $300, $400, $500 cards that they spit out there, and then on the other end is probably $5,000, $10,000, $15,000 cards they also have out there. I mean, they have a cap. So if you figure their average cardholder is a $3,500 cardholder, $2,800 is right in line with average, right? So it's not uncommon. Now, if you're somebody if you're a different lender like a Chase, and you're the biggest bank in the country, much less the world, and maybe you're not chasing around for $2,800 because you have other areas of business. Keep in mind, Capital One is predominantly credit cards. So, I mean, they do auto loans. I don't believe they're much in the mortgage business anymore. They don't do any personal loans. So, I mean, the best way to mitigate your loss mitigation for people, if your default rates are going up, is to do what they're doing. I mean, I really don't understand why more credit card companies don't do that. It doesn't make any sense to me why they just give their stuff away like that. And for cents on the dollar so somebody else can capitalize on it. I don't know why they don't form another entity that does collection. It doesn't make any sense to me. Why, if you're a bank and you're endlessly capitalized, why wouldn't you form your own collection company? Make it professional, do it right, and just every account that goes bad, roll it over there, and if you can't collect it, take them to court. It just seems so ridiculous to me that they give up so much profit with every one of these. You know what I mean? Like, literally, they sell these in tranches for like 2, 3, 4 cents on the dollar. So it's like a $10,000 card.
But if they write it off, Jay, why do that?
It lowers it, yeah, but understand, at the same time, though, these get booked as defaults. So that means your overall default rate goes up, right? So it doesn't look good from a banking perspective. Now, obviously, Capital One knows what they're doing. I mean, they've been in business forever. I'm just saying that I don't understand. When they write off the debt, let's say they charge off the debt, that essentially it takes off their taxable base, right? So it cuts down on their taxable base. They get to charge the debt off, so they get to write it off, right? So if they bring that money in later, it gets booked as earned income. But I just don't know why you would even go to that hassle. They could probably cut their default rates down so much. It's not like it's any easier, because if you've ever had to deal with Capital One, because I've settled accounts for clients and stuff, they have an early stage, a mid stage, a late stage charge off. Okay, that sounds like too many stages, right? Think about how many people are in that early, that the range is a waste. It seems like a complete waste of money to me, when you could just roll it off. When somebody starts going bad, you roll it off over to the bad Capital One, let them hound the people, and get them back on payment terms. And then this way, it's an alternative line item on their profit, on Capital One's profit sheet, and their default rate sticks down. It just doesn't make any sense. But you know what? Look, I'm sure there's a reason for it. It just won't ever make any sense to me.
Okay, so tell Lynn to have this her customer go do her taxes and bring this form with her, and it'll count as earned income.
Her account will know. She'll know exactly what it is. Okay. Yeah, her account will know what it is. But yeah, absolutely bring it with her. If she doesn't, tell her to expect a bill for $540 in the mail.
Oof, 500? I thought it was 2,800.
No. 2,800 was the amount of the card that was charged off.
Yes.
But they'll do it if she doesn't file it, because effectively you have to pay your earned income tax rate. So if her earned income tax rate is 20%, then she'll pay 20% on that.
Okay, I get
But
you.
if she doesn't pay, they'll use the worst case scenario to be like 35%, and they'll send her a bill for 35% at $2,800, which is like $500 or $600. So I mean, she could do it the easy way or the hard way. With the IRS, it's much, 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 much more intelligent to do it the easy way.
Okay. Oh, that was a question. I had another question over here about our professional do-it-yourself credit repair system, what people get with it. I know we've been hot this past 2 weeks, 3 weeks selling the professional system. A lot of people, catch on to how we dispute online with all 3 bureaus, and they want to learn how to do it. And yes, we have a professional do-it-yourself system aside from our $99 do-it-yourself credit repair system. That's more on a personal level. You fix your own credit. The professional system teaches you how to dispute exactly the same way that we dispute with doing disputes online with all 3 bureaus. Also comes with how to dispute by mail, and also comes with the inquiry removal template. And I believe, John, you said people get 3 or 6 months of additional support.
I've been giving them 6 months. That's all. I've been putting it together, because it's not cheap for the system. So I mean, I'm not trying to squeeze at every corner. It's not necessary. So, I mean, I've been giving them 6 months, and then if they still, most people don't need that much though.
Correct.
I just leave it out there, and if they do need it, it's there for them to utilize.
Correct. So yeah, this is so in someone said, Curtis. So in December, a lawyer called about a debt. I paid it clear, but last week another agency added to my report trying to collect on it. Look at that story.
Yeah, I mean, I'd need to see more about the scenario. There could be any number of things that occurred there. I don't know where it originated. I don't know if maybe the collection company that reported, a month or so ago, is the same when he paid under a different name, because some of them are larger and have subsidiaries. I mean, it could be a number of things. If it's not, and it's just on its face, and it's just, he sold it and somebody else is trying to collect on it, and it's something that he paid, then obviously he needs to call them up immediately and give them the new collection company that's reporting, provide him a copy of the payment and the receipt that the original collection company that he paid provided to him, and they'd have to remove it immediately. And they know that. I mean, there's no gray area there. So he's got a copy of the payment he made, and to whom, he'd be able to call them up. And if he knows that he paid the right company and he's got copies of everything and they don't remove it, I mean, his next call needs to be the Attorney General, because in his state, because that's, obviously that's a huge violation because of the amount of impact it can have on you, and impacts any move that you make. So I would definitely advise getting all his ducks in a row. And if that company did incorrectly report, you have copies of everything. Make sure, even if you don't, I'm sure, in this modern banking society, you should have an online, you should have a online payment reference on when you did pay that collection and to whom. And you should be able to provide that to them as well to circumvent and substantiate what you're stating that it should be reporting on there again. So either way, I would reach out to the new collection company, provide them that. They should take it off. If they don't take it off, time you're going to report them to the Attorney General. Get all your paperwork together, send it in. And trust me, it's a lot bigger problem from them if somebody reports them to the Attorney General and you have proof to substantiate that you made contact with them, gave them the benefit of the doubt, you provided them everything confirming they were wrong, and they still ignored you. That's a pretty big offense on their end. So you have recourse, though, without having to dispute it.
So,
like with the bureaus.
Okay. So I've been on an hour, 21 minutes. Again, we are taking on credit repair customers every day. We still take on credit repair customers on a daily basis, although we have our systems that sell as well. But we take on credit repair customers on a daily basis. This is the phone number that you guys text me on. You go to my website and get more information, and you can write your Experian credit monitoring. I know that recently you've been giving out quotes when people send you your that they're at Credit Karma info, Jay.
Yeah, just because it seems like
they don't want to pay for it.
It seems like it becomes more of a push, and some people don't want to set up the other one. And honestly, on any given day, there may be 20 or 30 quotes, right? And a percentage of them may move forward. So rather than taking it too far, with each and every person, knowing that a percentage of that larger amount moves forward. You know what I mean?
Oh, I get you.
I can substantiate 2 of the 3 bureaus that way, so they can get an idea, and if it's scaled out, we can confirm.
But I'm thinking everybody's going to start.
Most people just want to get a rough idea anyway, what it's going to cost, etc., and determine if it works within their scenario. And if it does, great. And if it doesn't, then we'll know right then and there, and then that'll either they'll come back at a later time or they'll move on to a different opportunity. So I mean, it's just a way of being more efficient and keeping things moving, and not trying to overcomplicate it.
Yeah, because through Credit Karma, we can only see Equifax and TransUnion, and now we've been sending people to Experian. At least they could see Experian for free, and you send me your login info, phone number, security questions, and answers to our email, GizzyCredit@GizzyCredit.com, and we usually get back to quotes, emails fairly quickly.
By the way, Credit Karma just got sold like last week. So
weren't they owned by TransUnion?
No, they were owned by a private company that was funded by Google, but they got sold to Intel. So there's going to be changes coming to that site. I'm sorry, not Intuit. I think it was Intuit that bought them. But either way, there's going to be changes coming to Credit Karma soon. So be prepared for it. Hopefully, it'll change for the better as far as the scoring model and things like that. I'm not sure it's going to, but I think it's just that the company that bought it did it as a way to draw on a larger customer base with more information and stuff like that. But either way, there should be changes coming soon to that site for anybody that uses it.
Okay. All right, Jay, I think we did enough. Again, John expressed for you guys to just be prepared. Take on don't just take on any new opportunity that you see. The market could go lower or it could go back up. Is that correct?
Yeah, I mean, it's in a lot more depth than that. But I mean, I think the idea is that, if we do continue to see a continued pullback here and it pushes lower, just understand with that, it's typically indicative of a contracting economy, and with that, capital flows start to contract, and with that, available money to borrow starts to contract. So it's best to position yourself properly. So if an opportunity does present itself and you do see a continued sustained pullback, you'll have that stuff in line ready to jump when you find the opportunity. So again, it's all about just our whole thing. If you've watched or listened to these podcasts since we started doing them in December till now, most of the stuff we sprinkle in a little bit of personal advertisement, like a hair of it in this process, and 98% of stuff we talk about is just to educate the consumer. I mean, really, in all fairness, I mean, we're not here pushing products on people. We're not here, every single time trying to pound you with information about how great we are, how incredible we are. You can find that out for yourself. And in a lot of cases, a lot of people have found out that we're good at what we do, at least on the credit side and a lot of other areas. But with that being said, a lot of this stuff is just for people to educate themselves so they make the right decisions. That's all. Because honestly, the one thing that we're lacking here in society is a centralized database from a credit perspective. We had a client that started today. It was a new client where we did the intake call today, because we do intake calls with all new clients. And,
Kyle.
Yeah, and in the conversation, we got on the fact of just about the massive amount of misinformation, how it lends to just everywhere, credit, debt related, and to a certain degree, market related, but much more so credit and debt related. There's just a lot of misinformation, and it helps a lot of people in nefarious ways. And I think the more information, even if it's generic or if it's specific, whatever it is, that you can provide to people to give them a much better understanding of what they're seeing, experiencing, and how they should be properly responding to it, or at least giving them all the facts so that they can make with their own brain, with a rational decision of how they derive it, give them the correct facts so they can make that decision, right? I mean, obviously we were talking about this early on in the conversation today about the market, and one of the guys or girls, I don't know who commented it, has said, okay, well, you need to capitalize for it and prepare for the way down. Absolutely. I couldn't have said any better myself, right? Correct. But we're giving them all that information so that he arrived or she arrived at that decision, right? Otherwise, they wouldn't have known. There's a strong possibility that behind this conversation, they may not have been looking at it like that. Now, whoever's listening to this or listens to it is going to look at it from a certain way that may allow them to jump on an opportunity or prepare accordingly to capitalize off an opportunity that could potentially make them a lot of money down the line, or they could prevent the possibility of making a bad decision that could lose them a lot of money, right? So that's what we're about. I mean, we're about educating. We're about, trying to provide people the right information, and if you guys decide to use it for the service, great. But at the very least, like we've said from the beginning, it would behoove you as a consumer to listen to these podcasts over and over and over again, whatever you don't understand, because the information you're being provided is factual, and it's stuff that will help you on this entire financial circle merry-go-round that people exist on a regular basis. So if you have other people that could be helped by it, definitely let them know. I mean, we try to do these as much as we can. And we try to cover some of these broad bases that we know we hear on a regular basis. So we know that they're common questions in the general consumer's mind. But at the same time, we're going to keep coming out with them to the best, as much as we can, and try and cover as much content as we can. And, if you guys have questions when listening, just let us know.
Okay. Before you leave, John, I got one more question. And just as soon as you said education on topics like this question right now. Only 6 more months until my bankruptcy is taking off my report. but I made the huge mistake of not building any credit since then. Only have one credit card, for example. Do you help people build credit? I think I need that even more than repairs, since in 6 months the BK will be off.
Right. So first and foremost, I'd want to make sure that the BK and all the accounts in BK were off first, because a lot of people have that time frame confused. They make assumptions, or they just don't read the report right. So I don't know where this particular person falls in line there, but
he's
yeah,
in
we
New
can
Jersey. He says New Jersey rules. So I don't know if it's a chapter 7 or chapter 13.
Right, but I'm saying that sometimes people just make the natural assumption of X date from X point in time, right? Whatever the case, if everything is off, we can definitely help rebuild. If it's not off, rebuilding is a lot easier than cleaning. I can assure you of that. So if you're saying 7 months from now, if you try and apply for a card now while you still have the BK on there and some of the accounts that were included in the BK, you're going to be rated to a certain degree. Any kind of mud that's left on the report is gonna translate into a higher rate or some kind of alternative rate or fee associated with it. So yes, to answer the question, yes, we can help build it. I wouldn't see the logic. I mean, I would want to confirm first that it's coming off in 7 months. If it is, then yeah, maybe you can start building it a couple months before. But doing it, 6, 7, 8, 9 months before, you're going to be standing around for a few months until it falls off, right? Because it doesn't take 6 months to rebuild it. You can lever that up pretty quickly, and you can do it pretty efficiently nowadays in the rebuild side of things. So that doesn't take 6, 7 months. But to answer the original question, yeah, we can do both.
Okay. So, Jay, when you have a bankruptcy, which is a public record, the bankruptcy stays on the credit report 10 years, chapter 7, correct?
Yes, for the most part, yes.
Okay. So the accounts that were included in the bankruptcy, and it says in the wording, account included in bankruptcy, does that account stay on the report for 10 years, or does that account still have a 6 year, 7 month time frame?
It's 7 years, 6 months. And yeah, well, depending on if it's expiring, it's 7 years, 6 months. But yeah, so the accounts are only 7 years, just round numbers. The BK will be there by itself after 7 years, just sitting there.
Okay. So if you want to go and build prior to that, they're still going to see that bankruptcy there when they run their credit, Jay. Should he wait till it's off?
That's what I was saying. I said, yeah, I answered that. I said that I think that if there's anything on that, you're going to get rated, right?
Oh, correct.
Any kind of negative, any kind of mud, any kind of hair that's on there, you're going to get rated in some form or fashion. If you have a thin file, it's going to be even worse. So if you have like no accounts on your credit and the one account is a BK, and you try to apply with the BK on there, it's going to be problematic because the limited history you have reflects a BK, right? So, I mean, if you're somebody that's got a thick, wide-filed, active reporting, paid off, et cetera, and you have a BK on there, it's not going to hold a lot of weight, especially if it's 9.5 years old, because it's effectively aged off, right? But, if that's all that's on there, I would, like I said earlier, you can start rebuilding it, but I would wait to apply until it falls off, because otherwise you're just going to be wasting increase.
Correct. And he says chapter 7, October 2010.
Wait, hold on. October 2010 was when it was filed or discharged?
I believe it was discharged, 2010. Mine is chapter 7. He doesn't say if it's discharged. I'm thinking it says discharge. But chapter 7, October of 2010.
Yeah, I mean, if that's the date of, then it should be, towards the end of this year. So, I mean, like I said before, though, I mean, I would.
He said discharge. He said discharge. It was discharged that day. But also he said, I did get one card about a year ago, but I won't try until another 6 months until it's off. But
yes, it sounds like he may have tried and didn't have a lot of success. And he maybe got one, but because he tried with a lot of other ones and they didn't approve it, he probably realized that he needs to wait, which is what I've been trying to say. I think you're better off waiting until, if it is a thin file, and I don't know what you've done with the one card you did get approved with, but if you keep those ratios down, obviously that's important too when you're applying for any new credit. If you're waxed on your ratios, the banks, even if it's a $300 card, banks don't want to lend out on that. So at least unsecured on the credit card side. So I would say, yeah, it could be built. Yes, the public record can also be removed. Either way, we can help you if you need our help. But if you're just going to rebuild, I would wait till about a month or two before it's going to fall off. to start that process, just because there's no point in doing it in advance, because it's going to mute the approvals and it's going to waste inquiries, and it's just unnecessary.
Correct. Okay. All right, Jake. You drinking your elderberries?
I'm not really sick. I don't know what's going on, but I've been coughing a lot. I've been drinking a lot of water, so I'm not sick though. I'm gonna keep telling myself I'm not sick. So
I know. We don't need you sick. I know that we haven't done podcasts in a while. I've been sick. So, and there's a difference in schedule timing with John being busy on Wednesdays. More than likely, we will be doing these podcasts on Mondays. We don't know yet if it's going to be every Monday, but if you guys enjoy this, if you like the comment, if you like the videos, we definitely could come up with a lot of topics to discuss. But you know, it says right here, I have a $3,500 balance. It's $3,500 limit. I have a balance of about $1,000. Okay.
All right, so it's good. So like 30%. That's good.
Yeah. So thank you, John, today. Everybody clap for John. Thank you, John, for making yourself available, educating us on what's going on in the market with the coronavirus and your credit. Hopefully you guys understood. I know a lot of people asked questions and we answered them. Thank you, people here on Facebook as well. And like, again, everybody says, great show, John. So most definitely, John. Thank you so much.
All right, guys.
And
thank you.
We'll see you soon. Take care. All righty, my people. Awesome. Thanks, you guys. Yeah. If you need trade lines, let me know. Email me or text me your email address and that you want the trade lines contact. Text me to this phone number. I'm going to send you my trade lines contact I've been dealing with for like 4 years. You know, everyone has, you know, positive things to say about him. It could be expensive because some of these trade lines are going to be on your credit report for 3 months. So if you're trying to do things in 6 months, maybe in 3 months or 2 months prior to that account being removed, you want to add it on your credit profile so that it could boost your credit scores. Okay. Again, we're here for you guys. Coronavirus, wash your hands. Don't touch your face, eyes, nose, mouth. Just don't be dirty anymore. Just, you know, be conscious of what you're doing, especially people who have beards or acne in your face. You're always touching your face. Get away from it. Listen, if you clean, if you're, I don't know. I'm not an expert. I'm just saying, be safe out there. Control yourself, and wash your hands at all times. Get some wipes, and don't go panic shopping. If you're gonna go panic shopping, go to a BJ's or a Costco's where you'll get things in bulk, so that when you go to your ShopRite, all right, or your Acme, you know, you don't rack up and leave nothing for anyone for everybody else. All right. So, anyways, my people, thank you, Gizzy. Hope all is well. I'm gonna see y'all later. And outro music coming up. Where's my outro music? Outro music. There it goes. See you later. Bendiciones. Anything you want, then you can get it. Don't be scared, because then you'll regret it. GizzyCredit. Oh. Anything you want, then you can get it. Yes, sanitizer too, San Juan. See you later. Don't get scammed, because then you'll regret it. You no longer gotta look pathetic. Look pathetic. Gizzy. Oh. There it goes. GizzyCredit. Anything you want, then you can get it. Don't be scared, because then you'll regret it. You no longer gotta look pathetic. Look pathetic. GizzyCredit. Oh. Oh.
Don't get scammed. What you need is just to change your plans.
Oh.
Time is money, you know, get that cash. Whatever form it comes, just get it fast, get it fast. GizzyCredit.
See you later.
GizzyCredit.
Oh.
GizzyCredit. GizzyCredit.
Peace out.